Let's dive right in. Now, you might be wondering about that magic number. For years, young professionals have had this exact figure locked in their heads thinking, if I can just save 1 crore rupees, my retirement is completely set. But is it really? Most people think they know the answer to this, but the math tells a terrifyingly different story.
Well, here is the absolute gut punch reality. If you factor in an average historical inflation rate of just 6%, your 1 crore rupees will effectively only have the purchasing power of about 31 lakhs in 20 years. Yeah, no way around it. The cost of living doubles, and your dream retirement fund gets slashed to 1/3 of its value in real terms. Let's actually project this out based on our source data to really put it into perspective. Say you want to retire today, and a comfortable lifestyle requires 2 crore rupees. Great. But what if you're planning to retire 30 years from now? With that exact same 6% inflation rate quietly chipping away at your money every single year, you won't need 2 crores. You will need 11.5 crores just to afford the exact same lifestyle. Inflation is literally the silent villain here. It's systematically eroding your hard-earned purchasing power over time without you ever even seeing it. So, what does this all mean? The crucial takeaway is this: just saving money is simply not enough. If you're hoarding your cash in traditional, overly safe, low-yield accounts offering maybe 3 or 4% interest, your money is basically just sitting idle. And idle money actively loses its purchasing power every single day. By trying to play it completely safe, you're actually actively losing the battle to inflation without even realizing it.
Section 1. The magic of compounding. To fight off that inflation villain, we desperately need a hero, right? And that hero is the magic of compounding. But what exactly is compounding? Simply put, it's earning returns on your original investment and then earning returns on those returns. Think of it like a snowball rolling down a hill. At first, it's tiny, maybe picking up just a few flakes, but as it keeps rolling, it gets bigger, picking up more and more snow with every single rotation until it becomes this massive avalanche. The longer it rolls, the faster and more aggressively it grows.
Now, what's really interesting here is how we can break that snowball effect down into 3 totally actionable pillars of discipline. It's known as the famous 15-15-15 rule. Step 1, invest 15% of your income, let's say 15,000 rupees every single month. Step 2, do this without interruption for 15 years. And step 3, aim for a 15% average annual return, which historically speaking, several equity mutual funds in India have actually delivered over the long term.
And if you lock in that discipline, do you know what the potential outcome is? Boom, 1 crore rupees. By just investing 15,000 a month, compounding does all the heavy lifting for you. This proves an absolutely vital point you should take away from this explainer. You do not need massive starting capital to achieve financial freedom. You just need extreme consistency and time.
Section 2. SIP versus PPF. Okay, so let's see how this builds into real-world choices. The 2 most popular paths for salaried employees looking to park their money are the Public Provident Fund, or PPF, and Equity Systematic Investment Plans, commonly known as SIPs. Now, one option gives you ultimate peace of mind, the PPF. It has a sovereign government guarantee, a fixed 7.1% return, and an incredibly attractive EEE tax-free status, meaning your contributions, your interest, and the maturity amount are all completely tax-free. The other option, equity SIPs, well, they bring market-linked risk, meaning your returns will bounce around a bit. But historically, they've offered between 12 to 15% returns, powerfully beating inflation even when you factor in the 12.5% long-term capital gains tax on your profits over 1.25 lakhs. Let's actually put them head-to-head with the math. Imagine you're making a 10,000 rupee monthly investment over a 15-year battle plan. In both scenarios, your total invested capital straight out of your pocket is exactly 18 lakh rupees. But watch how the numbers completely diverge based on the assumed returns. The fixed PPF at 7.1% generates a very respectable 14.5 lakhs in wealth. The SIP, however, even assuming a conservative 12% return for equities, generates a massive 32.4 lakhs in wealth. When we compare the final corpus amounts side by side, it really drives the point home. Honestly, this is a massive aha moment. Your final PPF balance sits at 32.54 lakhs. Meanwhile, the SIP final balance just rockets past it, all the way to 50.45 lakhs. That creates a staggering wealth gap of 17.91 lakh rupees. Just let that sink in for a second. That nearly 18 lakh rupee difference is the premium you earn simply by leveraging equity growth and the compounding effect over playing it totally safe.
It's the literal difference between just stashing your money away and actively multiplying it. Section 3. Low, medium, and high risk.
Now, our sources actually detail over 46 different investment plans. I know, it's a lot. To cut through that chaos, let's quickly categorize them into 3 simple buckets. First up is low risk. These are your near-zero market risk options. They're designed primarily to protect your capital, not necessarily to dramatically beat inflation. We're talking about the PPF we just discussed, traditional bank fixed deposits, the Senior Citizen Savings Scheme, which currently offers great rates over 8%, and sovereign gold bonds, which give you gold's price appreciation plus an extra 2.5% fixed interest every single year.
Next up, we step into medium risk. These vehicles offer a really solid middle ground of moderate growth and regular income generation with just a little bit more volatility. Here we have debt-oriented SIPs, monthly income plans that blend debt and equity, REITs for commercial real estate exposure without you having to go out and buy a whole building, and target maturity funds that lock in yields until a specific date. And finally, we hit high risk. If you want truly aggressive long-term wealth creation, this is exactly where you need to be. This bucket includes ULIPs, pure equity mutual funds, direct stock market investments, and IPOs. Yes, the risk of market swings is absolutely higher here, but as we saw with that SIP comparison earlier, the exponential compounding potential is what actually slays the inflation villain over the decades.
Section 4. Your long-term strategy.
So how do we actually apply all of this? Knowing your options is really only half the battle. If you have a 15-year horizon, time is heavily on your side, and that gives you the freedom to confidently weight your portfolio toward high-growth equity. A super common and incredibly powerful allocation recommended by financial experts is an 80-20 split. That means putting 80% of your investments into equity for that aggressive compounding, balanced out by a 20% debt buffer, like a PPF or a fixed deposit, just to cushion your portfolio against any sudden market drops. But listen, to maintain that kind of portfolio over decades, you're going to need absolute discipline. Here are the 4 simple steps to stay the course. Step 1, start with a clear goal. Is it retirement, buying a house? Define it. Step 2, start now, not later. Waiting around for the quote-unquote perfect market literally costs you years of compounding. Step 3, do not interrupt compounding. No pulling cash out early to buy a car, no pausing your SIPs just because the market had a bad week. And step 4, check in regularly, maybe once or twice a year, just to make sure that 80-20 balance is still holding up. Remember, consistency always beats capital. Ultimately, everything we've talked about today boils down to one undeniable truth. As our source material puts it so perfectly, time is the one thing in investing you cannot buy back. Think about it. Starting with just 2,000 rupees a month at age 25 will almost always put you in a massively better financial position than starting with 5,000 rupees a month at age 35. Which brings us to the final thought I want to leave you with today. Your money is doing one of 2 things right now, in this very moment. It's either quietly melting away to inflation or it's snowballing towards your financial freedom. There is no middle ground. The clock is ticking and the snowball is ready to be pushed. So, are you making your time count?